Hi everyone, it's Stephen here. If you've been thinking about getting a buy-to-let mortgage and you're not sure whether to choose repayment or an interest-only option, you need to watch this video until the end because I'm going to explain exactly when to go with repayment and when to go with interest-only and what I do. Plus, if you plan to remortgage your buy-to-lets to build your own property empire, what 2 things you need to be aware of before you do it if you like to sleep at night. A repayment mortgage works by paying the principal amount of the loan, which is the amount of money that you've been lent, plus interest payments on top of that principal amount in regular intervals over the term of that loan. So that term of that loan could be something like 25 years, even 30 years. And then at the end of that term, you'd have completely paid off that mortgage back to that lender. There's a term in the financial industry called amortization. Lenders love this because what it means is a way of calculating repayments that means in the first few years, you're paying way more in interest than you are in principal. This way, the banks make the most of their money up front. So let's take the example of a buy-to-let repayment mortgage that's £100,000 with 4% interest rate, and we're going to take it over a term of 25 years. This would mean that we've got a monthly repayment of £527.84. And this is made up of interest and principal payments. And the interest component is going to be about 333 quid, and the principal amount is just going to be around £194. So after the first 12 months of paying over 6 grand, we've only paid off the principal amount of around £2,400. And it's not till year 9 that we actually start paying more in principal off than we are in interest. And as the years progress, it's not till the last few years that we're really making a dent in the principal amount that we're paying off, with the final year being that we're only paying £135 in interest and over 6 grand in actual principal payments for that final 25th year. Every lender does this, and you'll see it as an expression on your mortgage offer letter as amortized over X number of years, however long that term of the loan is. This, for lenders, is the 8th wonder of the world for them. As property investors using repayment mortgages, we're building up very little equity in the property in those first few years. For example, in the first 5 years, we've paid £31,000 and we've only paid off £13,000 in principal. With an interest-only mortgage, you're not paying any of the principal amount off. You're only paying the interest-only component of it each month. As a property investor, we're looking to make the most amount of money in the least amount of time, and interest-only mortgages give us the ability to generate additional cash flow, which gives us more money in that same amount of time, because we're only paying the interest component of that loan off. We're not having to do a repayment part, which is doing the interest and the principal amount over that period of time. And most people are picking property investing because they want to generate cash flow and ultimately to become financially free. I know this was the case for me when I first started out. The downside means you're not paying any principal component off of this mortgage. So you need to provide the lender with what you're going to do to repay the mortgage at the end of the term, which typically is you'll remortgage it or you'll just sell the property. When I first started, interest-only mortgages didn't exist. What I did was, in fact, I bought my own home as a principal place of residence and I moved into it, and then after 6 months I moved out and rented it out. And how I was able to do that was I asked the lender for permission to rent the property, which they allowed me to do, and that property became my first investment property. So that one was a repayment mortgage, but since then all my other buy-to-lets have been interest-only mortgages, because I wanted to generate enough cash flow to generate another income stream, because ultimately I wanted to become financially free and quit my day job. I was working as an IT project manager back then, and I was fed up with the daily grind of battling everyone on the M25 and getting into a train on a rainy day and commuting into London. The other reason why interest-only mortgages are better for property investors is because inflation can actually become your friend. Let me explain why. Every year there's inflation. £1 20 years ago now costs us £1.62. That's a total increase of 62%. This means inflation has gone up on average 2.43% every year over the past 20 years. This is why putting money in a savings account that's delivering less than the inflation rate means you're actually losing money. So inflation doesn't go up in a straight line at 2.43% every year. We know it goes up and down, up and down, up and down. And it can be as high as 10% or something like that, like it is at the moment. The last 12 months, we're seeing inflation hit 10.1%. By holding on to a property and even doing nothing to it over that period of time, you would see that that property value has now increased over time because of the effect of inflation. So let's have a look at some examples of this on property prices. Here we've got a property in SE16 in London that was sold in 2002 for £208,000. And it was sold in 2022 for £750,000, an increase of 260% over those 20 years. This place in Watford was bought in late 2001 for £182,500 and it sold in 2022 for $562,500, an increase of 208% over those 20 years. But do we see the same type of percentage growth if we're looking up north? Here we've got a place in Nottingham that was bought in 2002 for £107,000 and it sold in 2022 for £231,250. That's an increase of 116%. That one's still gone up and it's still beating inflation at our 62% rate over 20 years. But what about the northeast? A place in Durham bought in 2002 for £33,500, sold in 2022 for £70,000. That's an increase of 109% over those 20 years. So not bad. Again, it's still beating inflation. It hasn't done as well as the Nottingham one or the ones in the south. But I did a bit more digging to see if I could find something that could still outperform those in Durham. And I found this place. Bought for £17,000 in 2002 and it sold in 2022 for £71,000. And that's an increase of 317% over those 20 years. So there you go. Does it matter whether you buy in the north or the south if you're looking for capital growth? When we're talking percentages, we're looking at a bigger number when we're converting that percentage into cash when we're looking down south. So let's say you bought the Nottingham one and that one was a 75% buy-to-let mortgage. That mortgage would be £80,000 and you did it as just an interest-only payment because you wanted to generate the cash flow. You wanted to become financially free, and over the next 20 years, doing that process, following those principles, that strategy enabled you to become financially free. In 2022, 20 years on from buying your property in Nottingham, that property has now been valued up at £230,000, which means your interest-only mortgage of £80,000 is still £80,000. But the loan to value now on that is 35% from 75% because inflation has eroded the value of that mortgage simply by allowing time to pass. But on top of this great news, you can also, if you want to, remortgage the property now because you've got a 35% loan to value. It's 20 years on, it's interest only, you've not come to the end of your term yet. Say you've got a 25-year term. After 20 years, you could remortgage that property for another 25 years at another interest only rate, but you don't need to go to 75%, you might just go to 50% loan to value because you want to be risk averse. It's 20 years further on, you've got different things happening in your life. But this way, you're still going to be making sure that your income is cash flowing because the rents would have increased over that same period of time as well. So if you increased your mortgage to 50% loan to value, that would give you another £35,000 to go again. And let's say you approach this strategy over the 20 years that you bought a property every 3 years, which I think would be easily achievable for someone on an average salary if they were just investing in the Nottingham area with that 30 grand down equivalent over that 20 years. So now you've built up a portfolio of 7 properties. Each one of those properties has the same amount of mortgage percentage. You can increase it to 50% loan to value and pull out that same amount of percentage, that 15% additional in cash as a lump sum to go again. So let's say as an average that you got 35 grand for each property, that's 245 grand to be going again and rebuilding on top of your existing portfolio this time in probably a bigger capacity. You could even start going, let's look at some commercial properties. So this is why interest-only buy-to-let mortgages are so powerful for property investors and why I'd recommend going with an interest-only buy-to-let mortgage. But remember those 2 things I warned you about. We need to be careful we don't get tempted to remortgage our buy-to-lets up to the full amount all the time, because as soon as we get some capital growth like we've seen in the last couple of years, we could be tempted to go, okay, I can remortgage that property and go up to 80% or 75% or even 85% in the good times with the lenders. Doing this quite frequently every 3 or 5 years on your property portfolio may mean it's keeping you awake at night. When times are hard, when the rents haven't risen for quite a number of years, when there's a load of deferred maintenance, when tenants are giving you hassle, not paying their rent on time or trashing the place or who knows what, you can't rent your property for some unknown reason, this is when you'll be pleased that you've got a low loan to value on your buy-to-let. So this is why when you become financially independent, it's important to maybe look at your property portfolio and decide which properties you want to start overpaying on, because you've got your cash flow, and therefore you hopefully will have some over that you don't necessarily need, which you'll be maybe using to go and buy more properties as deposits. But also think about taking a percentage of that and paying down some of these loans, and you can go up to normally about 5% on an interest-only mortgage without incurring any penalties to pay off some of that debt. Getting the balance right is a personal thing. It will depend on how much risk you like, and maybe the type of property that you've got and the quality of tenants that you can attract in that particular property. I do not see the point in getting a repayment buy-to-let mortgage before you're financially free, because you want to be generating the most amount of money in the quickest amount of time, and interest-only mortgages enable you to do that. If you're risk averse, when you become financially independent, maybe then you want to get a repayment mortgage if you like the idea of repayment mortgage. It helps you sleep better at night. But I prefer to get a buy-to-let mortgage on an interest-only term and make repayments on it at a time when I can afford to do so, up to that 5% per year, if I want to be lowering that loan to value faster than maybe inflation's helping me. But there's one nagging issue. You may not have yet bought your first buy-to-let property, and there's a hell of a lot to think about. So that's why you need to watch this video next, where I explain how to buy your first investment property with the least amount of risk and the least amount of aggravation. Thanks very much for watching. I really do appreciate it, and I'll see you next time.